I think the market is pretty happy about what Jerome Powell said the other day as well. So I think there are a few factors. One of them is that we have a very active Fed put potentially rate cuts coming our way. They would like to sustain the economic expansion, at least support it. So I think that's really what sort of helped the market in the near term. And the G20 thing is hope is still on the table. You know, China is 1/3 of the world's GDP. The U.S. S&P 500 has 40% or more exposure to China. You know, we need to be able to sell components there. They need to be able to sort of function without injecting liquidity. And I think that a deal is beneficial to both sides. And if we get one, it probably could lead to a rally here.
David, if the G20 ends in something less than comity, not comedy, comity, is that going to be the banana peel that could cause the market to slip?
We don't need an agreement. We have to agree to push the ball down the road, and I think the market will look at that positively. If there is a disagreement, if we are going to immediately increase the tariffs and the language gets more inflammatory, we do think the market would be prone to a pullback. Think about it. The market had a great 4-month period when it looked like the talks were going well and there would be some agreement. When those talks fell off, when President Trump started to talk about increasing the tariffs and talking about what a great thing tariffs were, you had the worst May that you had in a very long time, gave back a lot of the gains. The market is definitely going to react to tariffs and how we are with China. So if there's good news, we think the market can continue to do well. Bad news, we do think the market sells off. And it's very difficult to handicap what's actually going to happen.
Sylvia, what about bond yields? Do you see signs that those are incredibly overbought? You know, fixed income in general, that yields are too low? I mean, what signals do you read there?
Yeah, I think, you know, I think a lot of what's been happening in this market is that consumers have been on the fence in terms of whether or not they should stay in the market, and they've fled to cash instruments, to fixed income products, and also to defensive names. It's not a surprise to me that defensives are doing well today because the market rallied for a couple of days. G20 is still uncertain, so maybe take a little off the table until we know that there's going to be an equity rally going forward. You know, I think that some of the flows will continue into those names, but the yield isn't there. So you're still better off at least looking at the equity market.
You can't call it a yield anymore.
You can't call it a yield anymore.
I mean, so many of these countries, and it's not just Germany. I mean, Slovakia, Slovenia, Malta.
Absolutely.
Switzerland.
It's the world. It's the world. I mean, it's maybe a great time to consider buying that house, but that's about it.
You know, David, the other big story for the market is President Trump, who took aim at the Fed again, saying it's behaving like a, quote, stubborn child in refusing to cut interest rates. The president tweeting, the Fed doesn't know what it is doing, and that the Dow would be thousands of points higher and the GDP would be in the 4s and 5s. As they say in college, discuss.
Well, we think the Fed knows exactly what they're doing. We think the president, unfortunately, is acting like the child in this particular case. If you go back to candidate Trump in 2015, he was actually saying that rates were too low. Janet Yellen was artificially depressing them and that she was artificially inflating the stock market. The economy is actually in better shape today than it was back then. So if you look at what he said back then, that would argue that rates are actually fine or ultimately could drift higher. So we think the Fed is doing fine. What's clear about the Fed's meeting last week is they will be lowering rates, whether it's next month or the month after that. They're going to be dovish. We don't expect them to change that dovish policy for 6 to 12 months, and we think that's what the economy needs. The Fed can't lower rates enough if we enter a trade war with China. If we get out of that trade war with China, we think rates are great, and the economy and then ultimately the stock market can go higher.
Sylvia, your thoughts on the Fed and where rates are headed or where they should be headed?
I think it depends. I think it depends on what happens in the next earnings season. I think it depends on what happens with G20. I would think that if we get a good deal out of G20 and we see all the FANG names rally again and earnings still look stable as they did last quarter, then maybe the Fed would be less likely to cut as many times as the market expects. If we get no deal and we don't have any hope of essentially growth in GDP, economic expansion, and the consumer starts to see definable differences because of the China tariffs, meaning goods are more expensive. Companies have to move out of China into Vietnam, and there's a real cost borne. I would expect that rate cuts would have to essentially keep our market up.